There were three things that have happened in my life that are happening now. The creation of a lot of debt, which is monetized. In other words, the central bank prints a lot of money and buys that debt. Second, internal conflict. The size of the wealth gaps, the size of the political polarity that relates to the wealth gap, the size of the left and the right and the extremity of the left and the right, and also the rise of a great power to challenge the existing leading power and the existing world order, the rise of China, in other words. We began our world order in 1945 at the end of World War II, and that is the challenge. And those three things individually never happened before in my lifetime. So that pattern led me to want to understand the lessons from history. I learned that many of the things that surprised me in my lifetime just never happened to me before in my lifetime, but they had happened many times before. The first time that happened when I was clerking on the floor of the New York Stock Exchange in 1971. At that time, gold was the world's currency. The dollar was tied to gold. And so it was like checks in a checkbook. Paper money had no intrinsic value, and gold is what mattered. And we were losing gold. And on August 15th, 1971, President Nixon got on the television and announced that you couldn't get the money the gold to countries. And that was a shocking event to me. And I was very interested in markets. So I went down to the floor of the New York Stock Exchange and I expected pandemonium. And there was pandemonium, but it was on the upside, not the downside. And I didn't know why that was. Why did the stock market rally so much? And then I studied history and found out that the exact same thing happened on March 5th, 1933, when Roosevelt got on the radio and told the public essentially that they were not delivering the gold so that they could print more money. It's just that that was the first devaluation that ever happened to me. And I needed to go back in history. I needed to study the Great Depression. And because I studied the Great Depression, I and my company Bridgewater were able to anticipate the 2008 financial crisis, which we couldn't have done without that study. The value of the money should always be looked at in relationship to goods, services, financial assets, and other currencies. And so what we're doing is referring to also other currencies in describing that. The major reserve currencies, the major other reserve currencies, the euro and the Japanese yen. There's the emergence, but still small, is the China's yuan or renminbi. So the circumstances in the euro and Japan are quite like those in the United States because of the same element of the cycle. Everybody should judge their wealth not in nominal terms. Don't say how many dollars I have. Investors make the mistake of judging their wealth in the number of dollars or pounds or whatever currency they're looking at it. And they should judge it in relationship to buying power. When a government produces a lot of money in credit and they've handed out all of these checks and you use the measure of wealth as having risen a lot, everybody appears to have been richer. You cannot get richer by producing more money and credit. Okay, you can only get richer by producing more goods and services. And so what happens is by judging it that way, they make serious mistakes, particularly on judging the riskiness of cash. So for example, this year, investors, let's say, who are holding cash, probably lost about 5% to inflation, and they'll continue to lose inflation. And if you look at what's priced in the markets, they're negative real returns. In other words, the bond markets are negative real returns. So if you buy a bond, you're locking in a negative real return. And cash is worse than that. So I want to highlight, please do not look at your returns and think that that's safe when that's not safe. It's better to build a far better diversified portfolio. There's the broadest sense, and then there's the bond question. The broadest sense is be out of cash, have little or no participation in interest rates, particularly if they're close to zero interest rates, because if the economy goes down, they will offer very little protection to your portfolio because they won't go up much because they're close to zero interest rates. But you can get a diversified portfolio of assets, and that diversified portfolio of assets can include things like inflation index bonds and stocks and some element of gold and some other assets in different locations. Because if you know how to diversify well, you'll find that asset classes, it's not so much that wealth is destroyed as much as it shifts where it is. So by being able to see how it shifts and it moves around and looking at the correlations of those and achieving balance, you can achieve that kind of balance. I created what I called my all-weather fund when I first earned enough money that I knew that I would pass some along and I wouldn't be here. And I believed that active management would be a problem because active management is a zero-sum game. You got to pick the winners and the losers, and most people are not able to do it themselves. And those who are winners get filled up pretty quickly. And so it's not easy to operate that way. So I created this all-weather portfolio, which is a balance. Balance is the key. Diversification of achieving that is the best path, with staying out of the way of cash and looking at one's returns. The most common mistake of investors is to think that the markets that went up are good investments rather than more expensive. And so stay out of cash, achieve the balance, and then don't make that mistake. I remember when the Magellan Fund was the best performing stock mutual funds, when stocks were the best asset class and a very popular investment fund, but the average investor in it lost money. And the way the average investor lost money is because every time it was up a lot, they bought it. And every time it was down, they sold it. And so their bad market timing, because they were reactive, thinking it's a great investment when it's up a lot and when it's down a lot. And also you see ads that companies will put out ads are last 5 years return or this and that, or this is what the year is, to attract people in. And those are the common mistakes of investors. So don't try to time it yourself, because you'll probably lose. Competing in the markets is more difficult than competing in the Olympics. There are more people trying to do it and putting more resources behind it. I know what we put in hundreds of millions of dollars a year and so on to try to do that. And it's competitive for us. It's competitive for others. One of the great things about a stock index is that every company practically has gone broke. You go the Dow 30 and you see where they were not many years ago, and you watch them, and every company dies, but the stock market doesn't die because it rebalances to the new that comes in to replace the old. And I respect that particular process. So China's a bit over 4 times the size of the United States. So that means if it had a per capita income that was half the United States, it would be twice the size of the United States. And if you look back throughout history, in the book I show charts going back, 1,400 years. China has almost always been number 1 or number 2 in terms of its power. Of course, the world was much more separated then, but it was much quicker to invent the printing press and many technologies and so on, and had more power in many ways. And so it's a culture that is an old culture, and they study history and they are effective. And in the classic ways that are measured in the book, the 18 measurements. Education is important, civility is important, those kinds of things. And so what I've seen when I started to go there, I started to go in, as you say, in 1984. And when I first started going, there was the closed door policy up until Deng Xiaoping came to power in 1978, and they were just opening. And so the first company that was the only window company, they called it a window company because it was the only company that was allowed to look out and deal with the outside world, was a company by the name of CITIC. And they invited me to teach them about the world financial market. So when I went there, it was all bicycles and it was very poor. And I brought calculators, $10 calculators, and I gave them to leaders, and they thought they were miracle devices. And since then, per capita income, real income, has increased by 26 times. And their technologies, where they are in terms of quantum computing, AI, and almost any of them are rivaling the United States. So I saw that development, and I saw that basically, for the most part, they put together a bunch of right ingredients, including tapping entrepreneurship and creating capital markets, using capital markets, capitalism and a market economy to be able to be successful. Because when I looked at all the other empires, you look at the Dutch, the British, and so on, there was always the combination between ability of entrepreneurs to combine, to get resources, to take the new ideas and make them grow, to build the wealth and so on. And so anyway, they integrated and changed radically private companies and so on. And I've had the ability, because I've gone there so long and helped in many ways some of the developments of the financial markets understanding over that period of time, to know very intimately how the leadership thinks about such things. And the one thing that the Chinese are unique at is understanding the patterns of history themselves. History is basically their religion, and they study history and they learn the lessons of history, and then they have what they call the dialectic, when things are at odds and the contradictions, and how they then use that as a resolve. So something like capitalism and communism together, how they try to make that move. And so I can see they're earning more than they're spending. Their education levels are higher. Not higher in the total sense. You'll see the statistics, but they'll put out maybe 8 times as many computer engineers. They have free access to the data. They use data very effectively. So they've become quite remarkable in terms of technologies and so on. So they've gone from the evolution of countries. It goes usually from cheap things like you make textiles and so on, and then and manufactured goods, you're the cheap place to produce, to going into cutting edge inventiveness and technology. They made that evolution very effectively because of the way that they're doing things. So I've seen that up close, and I've seen that then they've developed their capital markets, and they welcome foreign investment. So that's what the picture looks like to me. The best success in life, not just measured in finances, but measured in the richness of one's life, is in meaningful work and meaningful relationships. If people are devoted to a mission to be great, and at the same time have those relationships, in order to have those relationships be most effective, they have to be radically truthful with each other and radically transparent. But let's take radically truthful. We have to get at what's true. And if you don't get at what's true, you won't know what to do about it. And the fact that if you're not radically truthful with each other, you won't get at that. You won't talk about problems or weaknesses. Everybody has weaknesses. Everybody makes mistakes. And the capacity to look at those and understand one's weaknesses. And then I realized that making money is no goal. It's sort of a stupid goal, because money has no intrinsic value. Only what can you do with money? But money is one thing, really the interaction. So for me, meaningful work and meaningful relationships, savoring life while I contribute in those ways is what I want to do.